I am Ashton Stewart, and this is my Finance 451 financial analysis. The two industries I did were the oil industry and the mass merchants. For the oil, I did Exxon, BP, Chevron, Marathon, and Imperial. For mass merchants, I did Dollar General, Dollar Tree, Walgreens, CVS, and Fred's. Over the course of my presentation, I am going to be referring to industry averages, and these are the industry averages I'll be referring to. I took the average of all 5 companies over the course of 5 years and developed the averages, so whenever I'm discussing it, these are the numbers that I'm talking about. So the first company I'm going to analyze is Exxon. Exxon's current ratio, they do not have enough to meet all of their short-term debt obligations, and they have about 46% of inventory on hand, which to me at first seemed pretty high, but looking at all of my other oil industry companies, they all seem to have a pretty fair amount of inventory on hand. Their cash ratio is pretty low, so overall I would say that Exxon's not a very liquid company. They have a leverage that is over 2, which means they are borrowing more from their creditors and less from their shareholders, which is a good thing because borrowing from creditors is cheaper. Their times interest earned shows us that they are able to meet their interest ratio each year, but towards 2014 to 2016, the numbers are decreasing, meaning in the long run they might not be able to meet these interest rates. Exxon's profit margin is fairly high when compared to the industry average, and it shows that your shareholders are keeping a high percent of sales return. Their ROA is also fairly high, meaning they are getting a return on their investment as well, and their ROE is also high, meaning their shareholders are getting a fair return based off of the initial investment that they invested in the company. Their tax burden and interest burden are both high, suggesting that they are paying less in taxes and interest. But their operating margin, when compared to these numbers, does fall short, suggesting to us that they are not as efficient as they should be. Their asset turnover is also falling short, and I would think that the operating margin is what is driving the return numbers down in this situation. Their PE ratio steadily increases over the course of 5 years, and their market to book ratio stays fairly the same, which suggests to us that the company does have a potential chance for growth. Their EVA is in the negatives, meaning they're not adding too much value to their company over the course of the 5 years. And their enterprise value is also, when compared to the industry average, it is higher, meaning that the market, once taking everything like their debt, their cash, and their cash equivalents into the picture, they do value the company more. The next company I will discuss is BP. BP has a current ratio that does suggest to us that they can pay all of their short-term debt obligations, and they do have a fairly high percentage of inventory on hand, and they have a higher cash inventory, which to me I would think is a good thing, so I'm going to say that BP is a fairly liquid company. They have a leverage that's over 2, so they are borrowing more from their creditors as well, and their times interest ratio in the beginning suggests to us that they are able to meet all of their interest rates, but in 2015 it falls short, and I'm thinking that this is due to them getting their final cost estimate back from the BP oil spill of 2010. It looks to us that the company is going to be paying out $61.6 billion in cost estimates to cover everything from that spill, so I'm thinking that their times interest is less because they are going to have to pay out more. Their profit margin is pretty low, and I am going to suggest that that's also because of the oil spill. And their ROA and ROE are pretty low in comparison to the industry averages, so I'm going to say that their shareholders are not getting as much back as they initially put in. They have a tax burden that's pretty high in the beginning, and then 2016 it drops down to the negatives, so I'm going to think that's due to the oil spill cost estimate as well as their interest burden is super high in 2016, suggesting to us that they're getting more time to pay back their interest. Their operating margin in the beginning is pretty low and then steadily decreases, and I'm going to think that that's telling us that they're not as efficient as they should be, and their asset turnover also decreases, meaning they're not generating as much as they're selling. Their PE ratio is very volatile. It switches up and down. In 2012, it's 11. In 2016, it's over 1,000. So to me, I would say it's too risky to figure out what's going on. And the market to book is steadily decreasing, meaning the market is not valuing the company as much as they should be. Their EVA is also in the negatives, meaning they're not adding much value to their company. And it starts in 2015 or 2014 all the way to 2016, and I'm going to say that that's due to the cost estimate coming out as well. And their enterprise value is lower than the industry averages, so I'm going to suggest that once the market saw their cash, debt, and cash equivalents, they did not value the company as much as they should have. The next company I'm going to discuss is Chevron. Their current ratio, they do have the ability to meet all of their short-term debt obligations, and they have a pretty good percentage of inventory on hand, just like almost all of the rest of them. Their cash ratio is pretty high, so I'm going to say that they're a fairly liquid company. Their leverage is less than 2, meaning they're borrowing more from their shareholders and less from their creditors, and to us, we would say that that's too expensive because borrowing from shareholders is more expensive than borrowing from their creditors. Their times interest earned in the beginning suggests that they are able to meet all of their interest rates, and in the end it drops to the negative, suggesting to us they can't meet those interest rates. Their profit margin is fairly high in the beginning when compared to the industry averages, but then drops to the negatives, suggesting to us that the market does not favor Chevron as much as they should. Their ROA and ROE both decline as well, so saying that their shareholders are not getting as much in returns as they initially invested. Their tax burden is pretty high in the beginning and then drops lower in 2016. So they were paying less in taxes, and in 2016 they are paying more, but it looks like they also took out more leverage too. So they took out more debts during that time. Their interest burden is over 100 the entire time, so they're barely paying anything in interest. Their operating margin suggests to us that they're not as efficient as they could be, and their asset turnover also decreases as well. So I would say that the operating margin is what's decreasing the numbers here. Their PE ratio is low, telling us that the market does not favor them, and the market to book ratio is also pretty stable, so it's kind of low, but then it increases in 2016. So it looks like they're doing pretty well for their shareholders there. Their economic value added is in the negative, so it doesn't look like they're adding too much value to their company over the course of 5 years. And their enterprise value is lower than the industry average, so the market does not favor them as much once taking everything like debt and cash equivalents into the mix. The next company I will discuss is Marathon, and Marathon cannot meet their short-term debt obligations. They do have a fairly low percentage of inventory when compared to all of the other oil companies we're looking at, and their cash ratio is pretty low in the beginning, but it increases in 2016. So overall, I would say that they're not that liquid of a company. Their leverage is less than 2, so they are borrowing more from their shareholders and less from their creditors. Their times interest earned suggests that in the beginning they're able to meet their interest rates, but in 2013 all the way to 2016 it's decreasing, so they're not really able to meet their interest rates. Their profit margin is pretty high, but it decreases in 2015 and 16. Their ROA and ROE are both fairly low when compared to the industry average, so they're not getting much of a return for their shareholders. Their tax burden in the beginning is low and then increases each year, so each year they are paying less and less in taxes, and their interest burden as well increases, so they're also paying less in interest. Their operating margin starts out pretty good. They start out really, really efficient, and then in 2015 and 2016 it decreases, so they're not nearly as efficient as they were. Their asset turnover decreases steadily the entire time, so I would say that the asset turnover is what's driving the numbers down. They're not generating as much as they are selling. Their PE ratio for the first 2 years is fairly high, but from 2014 to 2016 I don't have numbers for those. Their market to book steadily decreases, meaning their shareholders are not getting their initial return back. Their economic value added is in the negative, so they're not adding too much value to their company, and their enterprise value is way lower than the industry average. So once the market took all of their cash equivalents and debt into the mix, they did not value the company. And the last oil company I will talk about is Imperial. Imperial does not have enough to meet their short-term debt obligations, and they do have a fair amount of inventory on hand once comparing it to the other companies in the industry. They have a very low percentage of cash on hand, so I would say overall they're not a very liquid company. Their leverage is also pretty low. They're borrowing more from their shareholders and less from their creditors. Their times interest earned does suggest to us that they are able to cover all of their interest rates over the 5 years, but in 2014 all the way to 2016 it's decreasing. So I would say that they're not going to be able to meet those interest rates much longer. Their profit margin is fairly high when compared to others in the industry. So I would say that they are getting a good return for their shareholders. Their ROA and ROE are also fairly high, so their shareholders are getting a good return back for their initial investments. Their tax burden is pretty high in comparison to the other companies, and so is their interest burden, so they are paying less in interest and in taxes. Their operating margin suggests to us that in the beginning they were very efficient, and their asset turnover suggests to us that they are not generating as much as they are selling. Their PE is fairly high number, so their shareholders are getting a good return, and their market to book is as well. Their EVA spread is in the negative, so I would say that they are not adding much value to the company. Their enterprise value is pretty low in comparison to the other companies as well. Industry 1, my top pick is going to be ExxonMobil. After going over all the numbers, I think that Exxon is the best choice for the oil companies. So these are the industry averages I'm going to be referring to when I'm discussing mass merchants. The first company I'm going to discuss is Dollar General. Dollar General does have the ability to meet all of their short-term debt obligations, and they do have a fairly high percentage of on-hand inventory, which we would expect in this industry. Their cash ratio is pretty low, so overall I'm going to say that Dollar General is not a very liquid company. Their leverage is above 2 each year, suggesting to us that they are getting more from their creditors and less from their shareholders. Their times interest earned tells us that they are able to meet their interest rates each year, and it is increasing over the course of 5 years, so in the future they should be able to meet those interest rates as well. Their profit margin is above the industry averages, and their ROA and ROE are fairly high, suggesting to us that their shareholders are getting a good return. Their tax burden when compared to the industry average is below the industry average, but their interest rate is above. So they are paying a little more in taxes, but they are paying less in interest. Their operating margin decreases, showing that they're a little less efficient over the years, but it is still pretty high when compared to the industry averages. Their asset turnover suggests to us that they are turning over as much assets as they are selling. Their PE ratio and market to book ratio both increased from 2012 to 2016. The market sees a growth potential in the company. Their EVA is low, meaning they owed more than they were receiving, and their enterprise value is less than we would like it to be, so the market does not value them after they took all things like debt, cash, and cash equivalents into the picture. The next company is Dollar Tree. Dollar Tree does have the ability to meet all of their short-term debt obligations. Their on-hand inventory is pretty high, and their cash ratio is actually pretty high, so I'm going to say that Dollar Tree is a fairly liquid company. Their leverage is below 2, suggesting that they were borrowing more from their shareholders and less from their creditors, but it increases each year, suggesting they're borrowing more from their creditors. We don't know their times interest earn rate. Their profit margin is high, and the shareholders are getting to keep a higher percent of the sales, and their ROA and ROE is very high, meaning your return on the investment is better. Dollar Tree has a good tax burden and a good interest burden, and their operating margin increases each year, meaning they are becoming more efficient, and their asset turnover in 2016 decreases, meaning they weren't turning over as much as they were selling. Their PE ratio is very inconsistent, but it was higher than the industry average. The company does have growth potential, and the market to book ratio tells us that the company believes that they will do well for their shareholders based on the initial investment that the shareholder has put in. When compared to the other 4 companies, the economic value added for Dollar Tree was very high, meaning they are adding more value to their company. And when looking at the industry averages, their enterprise value was lower, meaning when taking everything like debt, cash, and cash equivalents, it is worth less to the market. Walgreens is able to meet their short-term debt obligations, and they do have a pretty good percent of on-hand inventory, but they do have less in cash, so I'm going to say that they're fairly liquid, but not as liquid as Dollar Tree. Their leverage is less than 2 all the way to 2015, meaning they were borrowing more from their shareholders and less from creditors, which is more expensive. And their times interest earned does suggest that they were able to meet their interest rates in 2012 and 13, but it does decrease over the years, so they might not be able to meet those interest rates in the future. Their profit margin is lower than the industry average, as well as their return on assets, but their return on equity is also lower, suggesting that the shareholders are not getting a good return. Their tax burden is higher than the industry average, as well as their interest burden. Their operating margin increases each year, but it is lower than the industry's average, so they are more efficient, but they are lower than the industry average. Their asset turnover is fairly low when compared to the industry averages, so I would say that the asset turnover is what's driving the ROE decomp down. Their PE ratio steadily increased over the years, and although they are lower than the industry average, the company has growth potential. The market to book ratio is also increasing, and the market believes that they do have value based on what they have already put in. The economic value added is lower than the industry averages, as well as their enterprise value is lower than the industry average. The next company is CVS. CVS is able to meet all of their short-term debt obligations, and they do have a good percentage of inventory on hand, but their cash ratio is fairly low, so I'm going to say that overall they're not a liquid company. Their leverage is less than 2 all the way up to 2015, so they were borrowing more from their shareholders and less from creditors. Their times interest earned suggests to us that they are able to meet their interest rates, but it is a little inconsistent, so we don't know how long they'll be able to meet those interest rates. Their profit margin when compared to the industry average is pretty low, and their ROA and ROE is also lower than the industry average, so their shareholders are not getting as good of a return on their investments. Their tax burden is higher than the industry averages, as well as their interest burden. So overall, they are paying less in tax and interest rates. Their operating margin is less than the industry average, so overall I'm going to say that they're not as efficient. Their asset turnover is increasing each year, so each year they are generating more than they're selling. Their PE ratio over the 5 years has stayed around the same, but their market to book has increased, meaning the market values the company more. Their economic value added was higher than the industry averages, and their enterprise value was also higher than the industry average, meaning that once the market took things like debt, cash, and cash equivalents into the mix, they did value the company more. The last company I'm going to discuss is Fred's, and Fred's is able to meet all of their short-term debt obligations. They do have a high inventory rate, and their cash ratio is pretty low, and in 2016 it's barely anything, so I'm going to say that they're not a very liquid company. Their leverage is less than 2, so they are borrowing from shareholders each year, so that's more expensive. Their times interest earned ratio all the way from 2012 to 2014 was fairly high, but in 2015 and 2016 it drops down to the negative, so they were able to meet their interest rates, but in 2015 and 2016 they were not. Their profit margin in 2015. In 2016 drops down to the negatives, and this also affected the ROA and ROE. Their tax burden was fairly high, and their interest burden in 2016 we don't have that, and I'm guessing that's due to their short times interest earn ratio. Their operating margins suggest to us that they are not very efficient, as well as their asset turnover is telling us that they are generating more than they are selling. Their PE ratio is higher than the industry average, and their market to book is lower than the industry average. Their EVA spread is telling us that they're not adding much value to the company, and their enterprise value is lower than the industry average, meaning that once the market took all things like cash, debt, and cash equivalents into the mix, they were worth less to the market. So my top company from industry 2 is Dollar Tree. And my overall company, my number one choice to pick after evaluating all 10 of the companies, I'm going to pick Dollar Tree because once looking at all of the numbers, I feel like Dollar Tree is less volatile. They don't change as much. They have steadier numbers.